All right, Bruni, one of the things that I was impressed about was the presentation that you gave at Chart Summit this year, where you were talking about market breadth. And I think that there's this misconception out there that equally weighted indexes and equally weighted sectors need to outperform the cap weighted for that to be an improvement of breadth, but you're saying that's nonsense.
Yeah, so like this past weekend I wrote a post on this exact topic. The first thing I did was look at the regression going back to 2003 when we have the data of the equally weighted S&P outperforming the cap weighted, and then I ran that against the S&P 500 on an absolute basis. And what you see is there's no relationship there. It's, it's all over the place. The R squared is like, 0.10. So essentially what that tells us is there's no relationship.
So to be clear, this is not the equally weighted versus the cap weighted. This is the ratio of the equally weighted versus the cap weighted compared to the cap weighted S&P 500.
Exactly.
Just to be clear.
Yep, exactly. And then what I did is I took it down to the sector level and did that same exercise. So I graphed the performance of each cap weighted S&P sector versus the equally weighted since the 2009 low, looked at that, and then compared the absolute returns of those, and the results were actually pretty interesting. So if you look at materials, they have the best performance on a equally weighted versus cap weighted basis. So, you would think they have to be the best performer, right? Great breadth, the most stocks participating in this sector, and then they're like 6 or 7 out of 9 in terms of absolute performance. And then if you look at consumer discretionary, best performance, it's up 600, 700% since the bottom. It has the weakest breadth. Amazon's a big part of it.
Yep.
So, it's sitting near its lows. It's making new lows pretty much every year, and it's the worst performer on an equally weighted basis. But then it has the best absolute performance.
It's the Amazon effect.
Yeah, exactly. So, and in India, it's even worse. So, just be happy you're not trading Indian stocks. But yeah, so I thought that relationship is really interesting because you often hear things that sound right, sound logical, but then when you look at the data, it just doesn't support it. So that's kind of the point I wanted to get at, not like, hey, let's go out and buy consumer discretionary now because it's the best performer. It's more so, exercise professional skepticism when you hear things and say, that should make sense. It sounds logical, but let me look at the data, see if it actually backs that up, and more times than not, you'll find it doesn't.
Okay, so then what is the lesson, right? Because we look at equally weighted indexes, we look at market cap weighted indexes, we look at the ratios, right? We put in the work. For those who, I don't want to call it a shortcut, but those who just want to okay, so what do we look at? How do we use this? What's the advice you give them?
Yeah, so I think it's less of a primary market timing tool and more of a, hey, let me see what's happening within this sector. There might be opportunities that are being masked by the performance of the cap weighted index. So for example, within materials, the relative uptrend in the equally weighted versus cap weighted has been intact for the last 10 years. We've seen the absolute performance of that cap weighted index has lagged, but underneath there have been stocks that are vastly outperforming the index and dragging that equally weighted higher. So to me, the lesson is, don't try to use this to time the market or time basic materials. Instead, use it as a indication and go look into that sector and say, what's driving this? I want to understand what are the best stocks within here that I want to own, as opposed to just going out and being lazy and buying the basket.
That's a good point.